Welcome to Thimbleberry U. I'm Michelle Odell, your host, for another great conversation about financial planning and asset management with Amy Walls. Good morning, Amy.
Good morning, Michelle. It's nice to talk to you today.
We have a lot to talk about today. Episode 83, Taxation of RSUs. Let's share with our new listeners or remind our prior listeners what a restricted stock unit or RSU is.
First of all, this is something that we see most often working with our tech clients, since most of our clients either work in tech or in healthcare. So a restricted stock unit, or RSUs for short, are a way an employer company can compensate an employee that isn't cash. And this form of compensation ties that employee's future income in the form of the RSUs to company performance and longevity with the company. Okay. So, we've heard about those golden handcuffs. I'm not going to say that RSUs in and of themselves are a golden handcuff. They could be. They're a form of it. So basically, it's a future form of stock that the employee will get if they still work for the company. In simpler terms, it's like an IOU, but with a commitment, right? If I give you an IOU, I'm also, in giving these RSUs as a company, making a commitment to how many shares you're going to get as my employee and at what point in time, as long as you are still an employee. So there are some key components to an RSU. Employers have to give out what's called a grant letter. This outlines all the details and rules and vesting. It's that IOU with details that an employee should have. That letter is very, very important. And in that, it will, as I said, outline the shares being granted, very important detail, and when they will vest. Now, some employers will vest those annually, some monthly, some quarterly, some it depends, some have switched during time. So that can be all over the board in terms of how frequently shares will vest. Okay. And vest basically means that they are now the employee's shares. They can turn around and sell them. They are no longer the company's shares. They've switched hands and are officially paid out to the employee.
Since we're talking about taxes, is there some background information our listeners need to know about taxes, and what is that?
Yeah, I guess if we're talking about taxation of RSUs, we need to know about RSUs and we need to know about taxes. So I think the gist here is that there are different forms of income and they're taxed differently. So there's ordinary income. This is like someone's salary. Okay, and that's what most of us think of when we think of income. It's salary that's coming in. Then there are capital gains. Capital gains are really about growth or gain for the investor on an investment that has been held for a period of time. So if they've been held more than 1 year, it's at a preferential tax rate, meaning lower than your ordinary income rate. And if it's been held 1 year or less, it's actually taxed as ordinary income. So those time frames matter. There's other forms of taxation, but I don't think they're relevant to talking about RSUs. I do think, though, that it's important to note that taxable income from a tax standpoint, your tax return is different than your salary. It's different than your capital gains. It's the conglomeration, the final result of all your income after any losses, after any credits, and after deductions on your tax return that actually goes against that grid that says if your income's between this and you file single, here's what you're going to pay. If you're married, filing jointly, and it falls between this and this, here's the percentage you're going to pay. That's taxable income, not ordinary income.
There's a lot of pieces to taxes, obviously. So how are RSUs taxed then?
At vest, so when they actually become the receivers, okay, that's the big thing that you have to keep in mind with most investments with taxes and when employers are giving things. The employee is not usually taxed. In the case of RSUs, they're not going to be taxed until they actually have control over the investment. So when those shares vest, they are taxed as ordinary income. So they're taxed just like the employee was taxed on their paycheck. Let's assume you're the employee and you had 100 shares vest, Michelle, and the stock price is $50 per share. Okay, so that's $5,000. But from a income perspective on your paycheck, you're going to not receive $5,000 in cash, but you will need to pay taxes Okay. What happens here is that the employer will actually hold back some of those 100 shares, probably somewhere in the 25 to 30 range, in order to pay the taxes, because we have federal taxes in Oregon, we have state taxes. There may also be some other items on the paycheck that those RSUs, that income actually gets applied to. That's pretty unusual, but it can happen. So that's why I say somewhere in that 25 to 30 share range. So you're going to end up with 70 to 75 shares typically.
Okay.
Okay. And so those are yours. So you did just receive them based on the value at the time they vested. So they were $50 a share. That's your basis. Now, if you decide you're going to hold those shares more than a year and sell them, and you sell them at $60 a share, you're going to have a $10 gain, right, that you need to pay capital gains on.
Right.
If you sell them at $40 a share, you'd actually have $10 a share in losses. And then if you sell, after less than a year, let's say that the $50 share price jumps over the next 3 months and is now $75. You've got a $25 gain per share, but because you're selling before they're a year old, before you've held them a year, I should say, you're going to pay ordinary income on that $25 per share. So I think that's really important to stress, because one of the most common misconceptions I hear about RSUs is that they are double taxed. And they're not.
Right.
They're not. What you originally get when you get it is taxed as ordinary income, just like your salary. But then it depends on how long you've held, and you get a new starting price based on the price that the shares were at the time you got them. So that's the important thing. Because they were given to you for free, some people have this misconception, and it runs through some companies like wildfire, that, if they were given at zero, gosh, I paid tax at $50 a share, and then when I sell it at $75, 4 months later, I'm getting taxed again on the full $75. Not the case.
Not the case. Okay.
To summarize that for our listeners, because I think that could get a little confusing, there's 3 main points to pay attention to: your grant date, your vest date, and the date you sell the stock. Grants when they give you them. Vest is when they actually become yours and you're taxed. And the sale is when you sell them, and the taxes there are going to be based on both the time and the difference in price between when they vested and when you're selling.
So far, this seems pretty straightforward. However, as in life, there's often a catch to these types of things. Is that true in this case? And if so, what is the catch?
You are correct. There is a catch, as with most things financial. There's a, give you and a gotcha. From a federal tax perspective, employers withhold federal taxes on RSUs when they vest at 22% of the vested amount. So let's use our example that we talked about previously, where you have 100 shares vest at $50 a share. And I said around 25 to 30 shares would be 25 to 30%. In other words, would be withheld to cover that tax bill. Well, on federal taxes, until you get to $1 million, they only withhold 22%. So they don't look at your income and your tax brackets on this. It's just a flat 22%. So in addition to the federal taxes, they may withhold, which is where I came up with the extra shares, right? Not just 22, but the extra 3 to 8 shares might be state taxes and those other things that could be withheld. So for 22% to be enough withholding in 2023, that person's taxable income, if they're a single filer, would need to be less than $95,375. And if they're married filing jointly, it would need to be less than $190,750. So that's important to note, because most of the time, at least our experience and with our clients, they are higher earners, their income, which includes the compensation from their equity compensation like RSUs, is over that amount. So there's a gap between what their tax rate is and how much is being withheld in RSUs, which means they're going to owe some money.
So assuming we receive stock in the form of RSUs, what can we do about this?
I think number one, it's what we've just talked about, knowing there's an issue, right? That's always the first thing, knowing you have a problem. So if someone has RSUs vesting, they should be expecting a tax bill. That should just be number one. Okay, I've probably got a tax bill. So now how do I plan for it? I think the best thing to do is at the very beginning of the year, look ahead and say, here are the shares I'm going to have vesting based on this price. Mm-hmm. And so let me do some math here. It's not very complicated math, but you have to kind of have the full year ahead of you. It's really hard to do after the fact when some have vested and some have been withheld, and trying to match all of that up. And then as vest dates happen, keep track of how much vested, right? Because the share price changed. Mm-hmm. And how much withholding was done for both federal and state taxes. And you can look at this and say, my employer under withheld at this vest by about $10,000. I need to take $10,000 from my extra cash or cash flow, and I need to set that aside to cover that tax bill at the end of the year. And if you do that at each vest period, you're going to be okay. I think the other thing that I probably said on many different episodes is you want to work with your team. And I'm going to say, when you are at a place where you have equity compensation, like RSUs, could be stock options too, it's a great idea to have a CPA and a financial advisor. Now, sometimes I'll find people just want to have one. Like we'll work with people that want to self-prepare their taxes. I really think getting the cash flow right and feeling comfortable and not being frustrated at the end of the year that I have a bill, why can't I get ahead of this, really involves working closely with both the financial advisor and the CPA and having them talking too, so that you can be prepared. You know, as a financial advisor, we're projecting forward for goals. Mm-hmm. Going back isn't so much what we do, but the CPAs are really good at that piece. And then when we can put our heads together and have a strategy that says, okay, if the stock price stays steady, we'll have a cash flow projection, but the CPA can say, yeah, you need to pay quarterlies. You'll be short this much. So find a way to set that particular piece aside.
And like you said, CPA is talking about what happened to you. You're talking about what's going to happen to you. And that makes a lot of sense to have those two types of people on your side. And that's what you do. If people have questions and want to discuss this with you more, how can they get a hold of you?
They can find us online at thimbleberryfinancial.com or give us a call at 503-610-6510.
Okay. Well, until next time, that was great. Thanks for the information, and we'll talk to you soon.
Sounds good, Michelle. Thanks.
Registered representative securities offered through Cambridge Research, Inc., a broker-dealer. Member FNIRA, SIPC. Investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated.